Well, so today we're going to talk about we're in a low vol environment, and so what do you do, right? And so today all I'm going to talk about is one concept. What do you do with an iron condor in a low vol environment? What is something you can do to, how would you maybe put on an iron condor in a low volatility environment? What do you do? Dino says you could wait it out. Yeah, but just here's a little idea you can do with an iron condor. And I think what I'm going to do today is, I'm not dealing with weeklies today, but it's the same principle. What I'm going to do is I'm going to bring up my whiteboard in a second, and I'm going to kind of draw, without a software, kind of draw what, the strategy and the concept that I'm talking about, and then I'll go look in a brokerage platform, give you the same example, and give you a picture. All right? Let us dig in. So again, what am I going to go over today? What I'm going to go over is show you what I would do with an iron condor. What's an idea to tweak an iron condor a little bit in a low volatility environment? There's many things you can do, right? You can narrow the put side, right? That's one thing you could do. But I'm going to talk about another idea today. So the example I'm using is RUT. And RUT as we speak. So this is an actual example. I'm not making this up. This is an actual example. We're going to look at a graph of it in a second. But RUT's at 1180, basically, right? And the RVX is basically at 18, which is kind of low, right? Now, I'm going to show you the iron condor example. We're going to look at the Greeks. Then I'm going to talk to you about the idea of what we could do with an iron condor in a low vol environment. So we're going to do all this in the whiteboard, and then we can take a picture of look at a picture of the position in a brokerage firm in a few minutes. Okay, just so you know. So here's the example of the iron condor. Right? Here's an example of the iron condor plain and simple as it is, right? So this is the iron condor without the tweak, okay? So I'm going to be in the, just so you know, I'm going to be in the July 15 expiration. I'll just write July once. I'm going to be in the July 15 expiration, which is approximately 35 days from expiration. So the iron condor I'm talking about today, we're dealing with 35 days to expiration. And Rick says RVX now has options. Ethan says, hello, Mr. Don Sheridan. Ethan just changed my name to Don. You can call me Don, but it's Dan. Don's okay too. Just don't call me late to dinner. All right, so we're looking at the July expiration for our iron condor, and we're looking at the July 15 expiration, which is 35 days from expiration. So can this apply to other durations? Yeah, I'm just using a 35 days today. That's it. So I'm buying 10 July. I'm buying the 1250 calls. And I'm selling the 1230 calls. So 20 wide credit spread. Again, this is where Russell is right now. So this is a real example. And on the put side, I'm selling the same July, 1120 puts and buying the 1100. So this is the Iron Condor without the tweak, right? These are puts. These are calls, right? I'm selling the 1230. I'm buying the 1250. I'm selling the 1120. I'm buying the 1100. This credit is going for around a $5 credit. Okay. And the Greeks of this trade are, right? The Greeks are the delta, that's a symbol for delta. So the Greeks of this trade 10 times were short 25 deltas, just a little bit short deltas. The gamma is minus 2.82. The theta is $109 a day that we're making in positive in decay. And the Vega is minus 555. So these are your Greeks of your position, right? And this is basically a what's the margin on this trade? Anybody know? What's the margin or risk on this trade? How much do you got to put up at your brokerage firm? What's the margin or risk of this trade? Anybody know? Okay, yeah, good. So you take the distance between the strikes, 20-point call credit spread, 20-point put. That's $2,000 of risk per trade. I'm doing 10 of them, right? 20 times 10 is 20,000. I'm getting a $500 credit, but I'm doing this 10 times. So my risk is 20 grand. The credit I'm bringing in is 5 grand. 20 grand minus 5 grand. So this has got a margin of 15K, right? So margin or risk of 15K. So the dilemma is in a low vol environment with RVX at 18. Oh, the other thing I want to mention is, not that it matters, there's different iron condors, but in this particular example, let me just tell you what I think the delta of the, in this particular example, the delta of the short call was 17 and the delta of the short put was 19. So in this particular example, the delta of the short call, the 1230s, again, putting the delta sign, was, I think, around 17, and the delta of the short put was 19. Okay, everybody with me? All right. Now, a question came in. Since the Vega value is the greatest among the Greeks, so the biggest Greek is the short Vega, does this mean this is a volatility trade? Well, I think there's many names to it, Steve. Just like if we had to label you, Steve, I could say you're maybe an American, right? But you also live in a particular city, don't you, Steve? So how do we label you? We say maybe you're a American. If you're from Chicago, you're a Chicagoan. If you're a policeman, you're a policeman. Do I label you as a policeman or a Chicago policeman or a United States Chicago policeman? So Is this a volatility trade? I think the biggest label that I would say this is an income trade, number one. So this is an iron condor. It's an income trade. Hey, Dan, why is this an income trade? It's a positive theta trade. And Dan, what does that mean? It means that the options I'm selling, right? Russell's at 1180. I'm selling the 1230 calls, 50 points out of the money, right? And I'm buying the 1250s. So I'm doing a call credit spread. The ones I'm selling, the 1230s, are a bigger number than the 1250s, and they're going to decay quicker. They're both out of the money, but the 1230s are going to decay quicker. There's more time premium. They're a bigger number than the 1250s. Same in the puts. You're selling the 1120 puts. They have more time premium than the 1100s. So when the volatility goes down a point, the Vega says we make $555. Why do we make $555, or why do we bring in positive theta? Again, our 1230 calls are going to decay quicker than the 1250s. The 1120 puts will decay quicker than the 1100s, so we're generating some positive theta every day, and that number will grow. In terms of volatility, volatility measures the time premium part of an option or the extrinsic value part of an option. So again, it's the same concept. We're selling more time premium or volatility component in the 1230 calls than we are the 1250s and the 1120s versus the 1100s. And so if the volatility goes down a point, we make $555 theoretically. If it goes up $1, we lose $555. So let's just get to the tweak here. So all we're saying is with the RVX at 18, kind of the lower end of the last year, how can we reduce this number without really reducing the theta a lot? How can we reduce our volatility risk? Dan, why would you want to reduce your volatility risk? Well, RVX is 18. That's kind of on the low end of the last year. If it goes up, being a 35-day trade, we have much more volatility. We have a lot of volatility exposure here. Now, so if I could keep the theta about the same and reduce this 50, 60%, that would be good, wouldn't it? So how do I do that? So basically, here's all it is, right? We're in the July 15 expiration, 35 days out. And Iron Condor is selling 10 July 1230 calls, buying 10 July 50s. Selling 10, 11, 20 puts, buying 10, 1100s. The tweak is going to be this, right? We're going to stay the same, sell 10 of the 1230s in July. That's going to stay the same. In the puts, we're going to sell the same 1120 puts. This is the regular July expiration. The only difference is instead of buying 10 of the 1250s, I'm going to buy 8 of the, excuse me, that's calls. Sorry about that. Instead of buying 10 of the 1250 calls, I'm going to buy 8. I'll get the questions in a second of the 1250s. This is the July expiration. This is the July 15 expiration. That's 35 days out from today. And on the put side, I'm going to buy 8 of the 1100 puts. So it's going to look like a normal Iron Condor. It just, instead of buying 10 here at the 1250, I'm going to buy 8, and then I'm going to buy 2 in the August 19 expiration. That's the regular August. 70 days out. I'll get to questions in a second. So there's no naked options. There are no naked options. So let's take a look. So I'm going to buy 8 of the 1250 calls in July, 2 in August, and I'm going to sell 10 of the 1230 calls on the call side. On the put side, I'm going to sell 10 of the 1120 puts, buy 8 of the 1100 puts, and I'm sorry, this would be the 1250s. On the put side, I'm going to buy 8 at the 1100 puts in July and 2 at the 1100 puts in August. So let me say it again what I'm doing. We're doing the exact same iron condor we did in July. Let me say it again. We're doing the exact same iron condor we did in July. The only difference, instead of buying 10 on our long hedge here, we're buying 8 and buying 2 of those 10 at a further duration. Instead of buying 10 of my hedge on the put side, I'm buying 8 and buying 2 1 month out, further expiration. That's it. It's not called a ratio spread because, again, how many calls do we have in this is the new spread here. How many total calls do we have in other words, we're buying 2 plus 8 is 10 and we're selling 10. So are we naked, short, or long any calls on the upside? No. On the put side, we're buying 2, we're buying 8, and we're selling 10. So there's no difference. Now, let's look at the Greeks. How do the Greeks change? Good question. So the Greeks of the original iron condor were delta short 25, gamma short 282, theta 109, and Vega minus 555. So remember, right, we want to keep similar theta but reduce our Vega. So the new Greeks will be this. Our delta will be minus 21, pretty close. The gamma will be minus 275. Pretty close. The theta will be 103, come down a little bit, right? But the Vega, instead of minus 555, the Vega will be minus 250. So the volatility, our Vega is going to be reduced by 55%. Ethan says, Mr. Dan, it's kind of messy. Ethan, you are 100% correct. Yes, it is hard to annotate on these things, and you are right. All right, so we reduce our short Vega by about 55%, right? Now, Rick Lee says it is commission intensive. Is that correct? Yes or no? Is it commission intensive? Let me ask you a question. Why is it commission intensive? Somebody tell me, why is it? Now, we haven't talked about the best way of getting this filled, have we? So all I'm trying to show you at this point is the regular iron condor, give you an example, give you the Greeks, give you this new proposed iron condor, give you the Greeks, let you see the difference, let you see here's a way to reduce your short Vega of an iron condor by 55%. So that's kind of all we've talked about. We haven't talked about, hey, how would I actually execute this yet, right? We haven't got in there. But commissions, I mean, you're still doing the same number of contracts. Is that correct? Are we still doing the same number of contracts? Yes or no? So if we're doing the same number of contracts, why would the commissions go up? If we're doing the same number of contracts, why would the commission go up? Right? Now, Ethan, I'm going to come over there, Ethan, and get you. Ethan, did you ever watch pro wrestling when you were a kid? Or I don't know, you might be a kid. Ethan says, Ethan says, would you please go? Oh, I got distracted. The good thing, Ethan, is this is recorded, right? I have not got distracted, Ethan. So I'm actually going through this. So Ethan, stay with me, buddy. I'm going to get you, and you ever see pro wrestling? You get a guy in a headlock and you give him a noogie. You know what a noogie is? You kind of get him in a headlock and you give him a couple shots to the side. I'm going to get you in a little headlock, give you a couple shots, right? Now, I would suggest going over, you can see this recorded, and you can watch it again. All right. So all we're doing is, here's the Iron Condor, 10 contracts. All I'm telling you is the only change we're doing out of my 10 Iron Condors, each of the longs, I'm saying I'm only buying 8 in July, and 2 I'm going to buy out another 30 days out in August. That's it. Now, any questions on that? Well, let's talk about, I guess we could talk about execution in a second. Everybody got the main feel of this? Let's go to now, this is what it's going to look like. Here's an Iron Condor. So the exact trade I talked about, folks. So here's the Iron Condor, right? That's the trade. There's the Iron Condor in the Greeks that we talked about. So we're buying the, I'm going to go over with you now. We got a picture. So on the call side, we bought the 1250s and we sold the 1230s. So this is the regular Iron Condor. And we sold the 1120 puts, bought the 1100s. This is the regular Iron Condor, right? We sold, we bought, we sold, we bought. It's the regular Iron Condor. Remember we said the deltas are about short 30, gamma short 282, theta plus 111, and Vega, so the theta was 110, and the Vega minus 559. With any Iron Condor, you can see your short strikes. Here's the 1230 strike. This is your expiration graph. We're using July, so we're about 35 days out from expiration. And this is your short put, the 1120 puts. Right, so we're making about the credit of, if we have a $500 credit doing it 10 times, we have about a $5,000 credit with risk of about $15,000 if I'm doing it 10 contracts. So that's the Iron Condor, right? So we'll talk a second about different ways to execute it, right? There's different ways to skin the cat. We'll get to that in a second. Is it going to be as easy as executing an Iron Condor? Yes or no? Is it going to be as easy as executing an Iron Condor? No, but let me ask you, in life, as an options, can you have your cake and eat it too usually? In life, as an options, can you usually have your cake and eat it too? Say no. No, right? We're reducing our stinking Vega by 55% and keeping our theta about the same. Agree? Let me say that in Spanish and a little Norwegian, right? We're reducing our short Vega in a low vol environment by 55%, keeping the theta about the same, right? Bringing in a credit of about $500, $5,000, and risk of 15. So that's the regular iron Condor. Now we're going to look at the tweaked version, talk about that, and then I'll finish talking about execution. Our deltas are going to be about the same. So, our deltas are the position deltas. The position deltas are within 2 or 3. All right, so now let's go to the other one, right? Stay with me. So now, let's throw in the calendars. And so now this is what the new graph looks like, right? Stay with me. Stay with me forever. All right, so now we have, this is our trade. We have, stay with me here. We have 8 in July of the 1250s, which we're buying. In August, we're buying 2 of the 1250s. On the 1230s, we're selling 10. We're selling 10, buying 8, and buying 2, right? We're just buying 2 in August. On the putty side, we're selling 10 of the July 1120 puts. We're buying 8 in July at the 1100s. And we're buying 2 in August, right? Again, regular iron Condor would be 10 and 10, 10 and 10. We're going 8 and 10, 8 and 10, and buying 2 more longs in August. Now, the Greeks. And then we'll get to questions. The Greeks. Our deltas are going to be short 25, right? And so we're within 3 or so for the short deltas. The gamma, it's going to be pretty close. So our gamma is minus 275. Before it was, I think, 285. The theta. Theta is almost 104. It was 109 before. And the Vega. And the Vega is minus 250. And before, the short Vega was 555. All right? So deltas are about the same. Gamma's about the same. Theta's about the same. Down 55%, ladies and gentlemen. And the other thing is, if you look at your risk or margin and position, the only thing that goes up a bit in a Reg T account, a regular margin account, not a portfolio margin, I think our risk was 15 grand. So this might be up near 17 grand. So you throw a couple more grand into the trade. Agree? Ethan says, Dan, would you please show the position in toss? Is that a later question? Because we got it in toss, right? Can you guys see this, what I'm doing? Can you guys see this? And this is the expiration graph. All right. So any question before we talk about how we might put this on, right? I think the reason, why do you think the margin went up a little bit? Does anybody know? Why did the margin go up a couple $1,000? Which would be about 10%. Why do you think the margin went up? Why do you think the margin or the risk of the trade the margin went up? Here's the answer. Will August 1250 calls cost more than July? Will August 1250 puts will August 1250 calls cost more than July 1250s? Will August 1100 puts cost more than July 1200 puts? Bing, 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 bing. That's your answer, right? That's it, right? Hey, Dan, why did you do only 2 in August? I wanted to reduce my Vega by about 50-55%. If I wanted to reduce my Vega basically all the way to 0, I would have done 4 in August, right? 4 in August, and that would have been 6 in July. So can I reduce my Vega to 0 this way? Yes. I chose to just reduce my Vega a little more than half. I think the Vega risk is much more significant to the downside, so do I. Do you ever adjust the puts to August? I'm not sure what that means. Do you ever, just adjust the puts to, just adjust the puts to August? You could. Yeah, I mean, there's other things you could do. Yeah, you could just do it the downside. You could. But that could affect your deltas too. Again, I'm trying to keep the deltas pretty much the same. The position delta is pretty much the same as when I had the iron condor on, right? Now, so let's talk a little bit. What are some different ways that, does everybody see this? Yeah, it's just an idea, I'm just throwing one thing out today. We can, literally if we had 10 hours, I could show you 47 different ways to 47 different ideas on trading for income in a low vol environment, right? And I could show you 20 different ways of tweaking iron condors to reduce the short Vega exposure or blah, 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 right? Now, so the last thing I want to cover today is how would I put this goofy thing on, right? How would I put this thing on, right? I mean, I've got this thing that is basically, I've got 8, 2, and short 10. And then I've got short 10, right? 8 and 2. So how do I put this puppy on, right? A couple different ways of doing it, right? All right. So what's one way of doing it? I'll go over a couple ideas. Step 1, I could do, and there's numerous ways. I can do 8 iron condors in July, right? I can do 8 iron condors in July, right? Step 2, sell 2, right? Right, sell 2, so if I do 8 iron condors, right? If I do 8, so if I do, excuse all the artwork here. So if I start out with this thing, right? I do 8 iron condors. I get that executed. That's step 1. Then, yeah, I mean, you could do, as Brett said, excuse me, I mean, there's a million ways you can do this. You can do so this would be the iron condor, step 1. We do it 8 times. And then I do 2 diagonals, right? 2 diagonals. Dan, explain. I will. So the first diagonal would be, I put in one order by 2 of your August and sell 2 of these July here in the calls, right? And then when I'm done with that, buy 2 of the August puts and sell 2 here, right? So would that cost me more commissions? Yes or no? Would that cost me more commissions doing it this way? Yes or no? Would this cost me more commissions? No. The only way it would cost me more commissions is if you got charged a ticket charge by your brokerage firm, which you shouldn't. Right? So we have rates that we don't pay ticket charges on, and a lot of students do. If you pay a ticket charge, it'd be a little more, but a lot of people have rates that they don't pay a ticket charge. Anyways, that's one way of doing it, right? I'll give you one more way of doing it, and then we'll call it a day, right? Another way you could do it is step 1, do your 8 iron condors. Step 2, do a calendar spread, right? 2 times on the call side at the at the 1250 strike. Buy 2 August, sell 2 July, and then do 2 calendars on the put side, right? At the 1100 puts. Anyways, so that's just an idea, right? Again, there's many different ideas, but the reason I picked this one today is because it just takes this a little tweak to an iron condor, and you can reduce the volatility 55%, right? Just a little bit of a tweak, right? And again, just like the day before you learned to ride a bike, when you were 3 years old or 4 years old or 5, if I would have interviewed you the day before you learned to ride your bike and said, hey, do you think it's hard or easy? You'd say, Dan, it's hard. It's hard. And then, 2 days later, you'd say, Dan, it's stinking easy. Well, if you've never done this before, right? Yeah, it's the hardest thing the world's ever seen. If you did it a couple times, you'd say no big deal. It's like anything in life, right? If you've never cooked at fettuccine Alfredo, it's probably hard. If you've made it a couple times, shockingly, that's not so bad, right? Again, this is relatively, Ethan says, what would you do when the underlying keeps going up? It is sitting on the cliff right now. Again, most of the time when I put on trades, they're pretty close to delta neutral, especially in relation to the delta and the Vega. So I put them on delta neutral, and then, so it doesn't matter. When I put them on and the point in time when I put them on, they're pretty close to delta neutral. And then, when they move against you, you have a plan. So the key to having any strategy on, if the market moves against you, got to have a plan, right? It doesn't matter if the market keeps going up or if the market keeps going down. What matters is that you have a plan, right? And that you learn how to trade, right? That you have a plan. None of these trades were designed to just put on and close your eyes and put on. So again, the original trade was 10 iron condors. All we did was take 2 of our long calls and puts and move them out to August. That's it. That's it, right? That's all we did. So for those of you, maybe you've never seen this before, You just watch the recording. Any reason you picked the short strikes that I did? No reason. I was just trying to get an example. This would be something I would call more of a, because I used higher deltas, maybe a 17 in the calls and a 20 in the puts. That would be a little lower probability, near one standard deviation, a little bit less. Anyways, second trade would be a calendar. Any other questions? Any other questions? How would I plan my entry? You know, my entry I would do just like I'm doing, you know, and I would do the iron condor first 8 times, and then I would do the other components. So probably a 3-step process. I'm not really getting as much into the whole risk management end of this today. I don't have enough time. But as far as exiting it, I'd probably exit it the same way I came in. Why obsession with Vega? Because if the market were to go down 100 or 150 points and the volatility would go up, it could hurt this trade pretty good. So no obsession with Vega. It's just, you know, as any option position, you have to look at the Greeks. I wish I could say what you don't know won't hurt you, but that's not true, right? Most people don't understand how volatility affects their options trades until it affects them. One last thing I want to share with you today. All right, so next week, we're doing a big event in Chicago. That's how you say it, Chicago. And we're doing a, let me show you this. Big Chicago event. We've got about 12, 13 different speakers. We do this event once a year. It's a live event. We have about 120 people. The event is sold out, the live event, but we also have streaming. Now, if you're interested, you can check out the event, who's speaking. We've got, I think, 11 different speakers over 2 days, about 7-8 hours a day. We've got a lot of very interesting speakers, some students from Sheridan Mentoring who are successful. I'll be speaking. Mark Fenton, who works with me. We'll have some people in the industry. Russell Rhodes from the CBOE. He's a volatility expert. Tom Sosnoff from Thinkorswim, TD Ameritrade, and Tasty Trade. We'll have the SPX, for those of you who are at Thinkorswim and other firms, the actual broker in the SPX who does your trades. His name is not Bobby Brown. His name is Brian Brown, and he's going to be in there trying to explain to you what goes on in the pit. He'll be there. We'll have Brian Overby from Trade King will be there. So we'll have a lot of practical presentations on people, how they trade, what do they do each month, and some of these different strategies. There'll be a lot of specific, very good trading ideas for you. People will be sharing exactly, hey, this has been working, this works, you know, and you'll be able to see that and get a lot of good ideas. But you can watch the streaming. You'll have the archives also. You get the PowerPoints and 2 full days of it. And you can get some information here. And that'll be Thursday and Friday of next week. The live event is already sold out, but you can watch it streaming, and it'll be a heck of a 2 days. Have a good day. Any other questions, you can email me, dan@SheridanMentoring.com. And have a wonderful, wonderful day. See you guys later. Thanks.